You know, a trader learns early that markets don't shout their intentions. They whisper them, softly, quietly, almost as if testing whether you're alert or just another gambler reaching for fast money. And if you've been studying the tape long enough, you'll notice something curious. Before some of the strongest profit runs of the week, the market performs a sort of pause, a stall, a hesitation. Have you ever seen a stock that goes still, almost lifeless, only to burst into motion the very moment the crowd stops paying attention? That pause isn't accidental. It's deliberate. At least, that's how I always viewed it. Markets, like people, need a breath before they run. And if a trader gets impatient in that quiet moment, he's liable to miss the whole point. Tell me, how many times have you seen a chart flatten out and assumed nothing was happening, only to watch it launch a clean trend while you were off chasing some noisy mover? You see, most of the public thinks that action equals opportunity. They want loud candles, big breakouts, exciting headlines. But in my experience, the best moves tend to originate from silence. The big interests, the ones with deep pockets and deeper patience, don't make their moves when the tape's screaming. They build their positions when the tape looks dull. And if you train your eyes on that dullness, you'll notice footprints. Maybe the volume tightens. Maybe the range compresses to a point where you can almost feel the tension under the surface. Ever put your finger on a chart like that and felt it trembling with potential? I learned early that a trader must become comfortable with stillness, that hidden market pause is not a signal to act recklessly, it's a signal to observe. To let the market tip its hand. Because if you force a trade during that pause, you're fighting the very rhythm that precedes the genuine run. And believe me, the market doesn't reward traders who fight its rhythm. Ask yourself, are you one of those who rush into trades simply because you're bored? Most traders don't fail from lack of intelligence. They fail from lack of patience. They want constant excitement. They forget that the market is a teacher with a strange sense of humor. It offers the lesson only after you've paid the tuition, and one of its greatest lessons is that the pause before the move is often more informative than the move itself. That pause tells you whether buyers are accumulating or sellers are distributing. It shows whether supply is drying up. It shows whether the stock has had enough time to shake out the weak hands. Without that pause, a move is just noise. With it you have structure, and structure is what lets a trader build wealth steadily instead of gambling every morning like a man who's lost his sense. When you study a chart, don't just look for the breakout. Watch the behavior before it. Notice how some stocks will trade in a tight range after a decline, almost like they're refusing to go lower. That's a sign. Or how a strong stock will rest sideways after a run, not giving up ground even when the broader market wobbles. That's another sign. Ever wonder why some stocks refuse to break down even under pressure? They're being held up for a reason. Now, this doesn't mean every pause leads to profit. Nothing in the market works every time, and any trader promising certainty is either a fool or a salesman. But if you learn to recognize the pauses that matter, the ones with contracting ranges, controlled volume, and behavior that suggests quiet preparation, you put yourself on the right side of probability. And probability, not prediction, is the trader's real craft. You'll find that the best wealth building in this business comes from stacking those probabilities in your favor over and over, rather than swinging wildly at every bit of action that flashes on the screen. And let's talk about the money mindset for a moment. Too many traders think in terms of quick wins. They're obsessed with how fast they can flip a position or how soon a trade will take off. But ask yourself, is that how the big interests think? They accumulate quietly, they wait patiently, and they strike only when the market confirms their bet. They treat the pause as part of the plan, not an inconvenience. If you want to build real wealth in trading, not overnight wealth, but steady, disciplined equity growth, you must start thinking like they do. You must be willing to wait through the dull stretches. You must be willing to sit while others get restless. Ever noticed how the most profitable traders are often the calmest ones? You see, The true value of noticing the hidden pause is not just catching the move that follows, it's training your own temperament. It teaches you to stop lunging at every price flicker and instead let the market come to you. And once you internalize that, something changes in the way you trade. You start to act, not react. You begin to lean into the setups that matter and ignore the ones that merely stir your emotions. That's where discipline grows, and discipline builds capital just as surely as the right trade does. Because you can't hold on to a profit run if your mindset is shaky. You'll bail too early. You'll panic on the pullbacks. You'll sabotage the very opportunities you worked so hard to catch. But if you enter a move because you recognize the pause, the tightening, the calm before the break, you enter with conviction. You understand why the move might unfold, and that understanding steadies your hands when volatility arrives. Tell me, how many times have you exited a trade too soon simply because you didn't understand its foundation? When you think about it, the hidden market pause is a test, not of the stock, but of the trader. It asks whether you can wait without acting foolishly, whether you can see what others overlook, whether you can trust your study of the tape enough to sit calmly while the market holds its breath. Because once the breath is released, well, those are the moments traders spend their whole week waiting for. And the truth is, these pauses appear more often than most traders realize. They happen at the start of the week, in the middle, and sometimes right before Friday's close. But they're subtle. You have to tune your eyes. You have to stop demanding noise from the market and start listening for the silence. The silence reveals more, always has, always will. The strongest weekly trends often begin with a period of unusually tight price compression, and if you've watched enough charts in your life, you'll see this pattern repeating itself like an old habit the market just can't quit. Most traders ignore this compression because it looks boring, almost like the stock has gone to sleep. But that's exactly why it matters. When a market goes quiet, it isn't always losing interest. Many times it's gathering strength. And if you've ever wondered how some traders seem to catch moves that look practically effortless, it's because they've learned to respect the stillness before the storm. Ever look at a chart and think, nothing's happening, only to find out later that everything was happening right under your nose? Tight price compression is the market's way of telling you that buyers and sellers are reaching a temporary agreement. But it's also telling you something more subtle. Uncertainty is shrinking. Volatility is drying up. The wild swings are settling down. And this quietness is what often invites the big interests to position themselves without drawing attention. They don't need dramatic candles. They prefer the shadows of those calm ranges. And if you train your eye correctly, you'll start to see that compression doesn't mean indecision. It means preparation. The market is coiling. It's winding up. It's storing energy. Have you ever noticed how a spring feels hardest to press right before it's released? Most beginners misread this setup entirely. They crave activity. They want to see the stock sprinting before they join the race. But by the time the stock starts sprinting, it's usually too late to secure the best position with the best risk to reward. The professionals have already taken their spots during those tight price zones, long before the breakout. That's the irony of trading. The real opportunity rarely looks exciting at the moment you must seize it. It looks quiet, sometimes dull, almost always uninteresting. If you want excitement, the market will happily give it to you, just not in a way that builds wealth. So ask yourself, are you hunting for movement, or are you hunting for structure? Price compression often shows up after a decline or just before a continuation of a trend. In both cases, the message is similar: supply and demand are reaching a temporary equilibrium. An equilibrium leads to imbalance. One side eventually cracks. That crack becomes the movement everyone notices, but the trader who studied the compression saw it forming long before the public reacted. This is the difference between chasing and anticipating. Chasing drains an account slowly. Anticipating responsibly builds it. When you see a stock's daily range shrink for several sessions, you're witnessing the quiet negotiation that precedes the next expansion. And have you ever wondered why so many breakouts fail? It's usually because they didn't have this tightening beforehand. They had energy, but no organization. Compression gives you clarity in your risk. When the range narrows, your stop loss can be tighter without being emotional. And when the breakout finally occurs, whether up or down, you have a clearer indication of direction. That's the beauty of compression. It reduces the noise and sharpens the signal. Most traders place entries during chaos, but the seasoned trader waits for this exact quietness. And quietness is uncomfortable for most people. It demands patience. It demands discipline. It demands you sit still while everyone else looks for action. Do you ever feel uneasy when the market slows down, as if you should be doing something just to feel involved? This mindset is where many traders sabotage themselves. They can identify the compression but can't sit through it. They need movement. They need confirmation. They need excitement. But money in this business flows to the patient, not the restless. Price compression teaches you how to observe instead of react, how to position instead of chase, how to read the market's breathing patterns instead of its shouts. When you start valuing this stillness, your trading shifts from impulsive to intentional, and intentional trading is where consistency begins. Think about the biggest weekly runs you've seen. How many of them began with a sudden explosion out of nowhere? Not many. Most started with several tight candles, volume tapering off, ranges narrowing, and traders losing interest because they didn't see movement. That's the point. The market hides its best opportunities behind boredom. It hides its strength inside calmness. The crowd wants fireworks, the professionals watch the fuse, and the fuse almost always lies inside the compression zone. Ever scroll through old charts and notice how the best trends start where the chart looks almost flat? When you recognize that tight consolidation is not stagnation but incubation, your whole relationship with the market changes. You stop forcing trades and start discovering them. You stop reacting to noise and start reading structure. You stop needing action to feel alive in the market and start letting the market's rhythm guide you. This is when you begin to understand why the strongest weekly trends don't announce themselves with drama. They whisper first. They whisper through silence. They whisper through compression. And the traders who learn to listen to that whisper find themselves entering trends not because they're chasing, but because they saw the pressure building quietly, steadily, patiently, long before the move. Hidden pauses help separate genuine trend setups from impulsive, low-quality breakouts. And once you've spent enough time watching the tape, you begin to understand why this single distinction can make or break a trader's entire week. Most traders believe every breakout is worth chasing, but the truth is that most breakouts are traps. Quick bursts of excitement with no real strength behind them. The market knows how to lure the impatient, the emotional, and the undisciplined. It flashes a bright candle, triggers a few buy stops, and then snaps right back, leaving latecomers holding the bag. Have you ever entered one of those fast moves only to feel the market reverse almost immediately, as if it waited for you? That's why the hidden pause matters so much. It's the market's way of revealing whether a move has real weight behind it, or whether it's just noise dressed up like opportunity. When the market pauses before a trend, it's not random. It's a sign of underlying order. Price settles. Volume tightens. The stock takes a breath. This resting phase tells you that the big interests aren't rushing. They're positioning thoughtfully. When a breakout comes from that kind of structure, it tends to behave smoothly, almost effortlessly, and the trader who recognizes this setup can ride it with a clearer mind. Ever notice how the best moves don't feel chaotic once you're in them? Contrast that with impulsive breakouts. These usually come from loose, sloppy price action. The range is wide, volatility is high, and the candles whip around without rhythm. This is where the amateurs get their signals. They see a sudden spike and think, this is it. But impulse isn't the same as intention. Impulsive moves lack preparation, and the market punishes unprepared moves the same way it punishes unprepared traders. You can feel it in the tape. The breakout jumps, hesitates, and collapses. It never had support beneath it. It never had a base. It never had that pause that shows accumulation, digestion, or genuine interest. If you've been caught in one of those sharp reversals, you know exactly what I'm talking about. Haven't you ever wondered why a breakout looked perfect until you bought it? The hidden pause is where the separation occurs. It's where supply gets tested. It's where weak hands exit. It's where stronger hands take control. If a stock can hold its ground in that quiet zone without leaking lower, it tells you buyers are willing to support the price. If it holds without surging upward prematurely, it tells you they're patient. And patient buyers are usually strong buyers. They're not chasing, they're accumulating. This is why pauses feel so calm. They're controlled environments. The price behaves like it's under the influence of a steady hand. When a move emerges from this kind of control, it's more likely to trend cleanly. Ask yourself, do you feel more confident entering a breakout that's built a solid base or one that just erupts out of nowhere? A trader who learns to differentiate these setups begins to see the market in layers. The public sees the move. The trained trader sees the preparation behind the move. And once you understand preparation, you stop being impressed by flashy candles. You stop reacting to sudden spikes. You stop falling for the market's theatrics. Instead, you look for the quiet signs. Tight ranges, controlled pullbacks, diminishing volatility. These are not exciting to the untrained eye, but they are the fingerprints of real strength. They are the moments when professionals reveal their intentions without saying a word. The tape always tells the truth to those willing to observe. When you rely on hidden pauses to filter your setups, your trades naturally become more selective. You stop taking every breakout that appears on the screen. You start demanding structure. You start waiting for proof that a trend is not only possible but likely. And probability, not excitement, is what builds a trader's account over time. Have you noticed how much clearer your trading becomes when you reduce the number of impulsive trades? Another important thing about pauses is the emotional advantage they give you. When you enter a trade from a calm base, your risk is clearer. Your stop loss can be tighter. Your entry is more logical. And because the breakout comes from orderly conditions, the price often moves cleaner afterward. Clean moves are easier to manage. Choppy moves drain a trader's psychology. Many traders think losing money is what exhausts them, but more often, it's the emotional toll of trading unpredictable patterns. A trend born from a proper pause behaves differently. It's smoother, more directional, more cooperative. It feels like you're moving with the market instead of fighting against it. Haven't you ever felt the difference between a trade that glides and a trade that thrashes? And here's the real beauty of hidden pauses. They force you to slow down. They make you watch, study, interpret. They encourage patience instead of impulse. They teach you to read the market's intentions rather than its noise. And once you start valuing these pauses, your trading transforms. You stop entering because you feel you have to trade. You enter because the market gives you a reason. You enter because the structure supports your decision. You enter because the pause revealed the difference between a real trend and just another fleeting move that would have pulled you in and shaken you out. Patience during market stillness is a trader's edge, not an obstacle, and if there's one lesson the market teaches again and again, it's that the quiet moments separate the professionals from the restless crowd. Most people don't like stillness. They get uneasy when the tape slows down. They want movement, action, something to react to. But a trader who learns to sit through those calm stretches without forcing a trade gains an advantage that's far rarer than any chart pattern. Have you ever watched the market go flat and felt that itch to click the button just to feel involved? That itch is the enemy. It pushes traders into weak setups, premature entries, and emotional decisions. When the market settles into stillness, it's not giving you nothing, it's giving you clarity. It's telling you, wait, not yet. And if you can listen to that message without fighting it, you're already ahead of most. Patience is not passive, it's active discipline. It's intention. It's the trader's version of positioning before the opportunity shows itself. Too many traders view stillness as dead time, but in reality, That stillness is the exact space where the next big move is quietly forming. Haven't you noticed how often strong trends begin right after a period when nothing seemed to be happening? A still market is full of information. When price barely moves, you can observe who's really in control. Does the stock refuse to drop even when the market dips? That's strength. Does it fail to bounce even when the indices rally? That's weakness. Stillness shows you the character of the stock, and character leads to direction. During these calm stretches, supply and demand negotiate under the surface. You might not see big candles or wild swings, but you see balance tightening. And tight balance always resolves with expansion. This is why patient traders are often the ones capturing the smoothest runs. They weren't hunting noise, they were watching structure. Think about it. How often have you been shaken into a bad trade just because you couldn't stand waiting? Impatience is expensive in this business. Each rush trade chips away not only at your capital, but at your confidence. And once your confidence erodes, your judgment follows. People underestimate how much mental capital goes into trading. If your mind is scattered from jumping into low-quality setups during still markets, you won't have the mental stability to handle the real opportunities when they appear. But patience fortifies you. It keeps your thinking sharp, your emotions steady, your strategy intact. When the market is quiet, you're not supposed to leap. You're supposed to observe. Ever notice that the trades you regret most often start from boredom instead of real conviction? Something powerful happens when a trader grows comfortable with waiting. You no longer treat the market like a casino where you must always be in a position. You treat it like a business where timing matters, conditions matter, and quality matters far more than activity. You start to see that the market doesn't reward movement, it rewards discipline. Patience lets you avoid the traps laid during dull chop. It keeps you from wasting energy. It saves your attention for the setups that deserve it, and attention is a valuable resource. Most traders burn it on noise long before the real opportunity arrives. Have you ever felt drained before the day even produced a proper setup? In stillness you can plan with clarity. You can define your levels. You can study the basing pattern forming. You can identify where the buying pressure appears and where the selling dries up. When the market moves too fast, it forces you to react. But when the market is still, it invites you to prepare. This preparation is a huge edge. By the time the breakout happens, you're not guessing, you're executing. You know your entry, your stop, your target ranges. You know whether the stock earned your attention or not. This level of preparedness only comes from respecting stillness instead of resisting it. Patience also builds emotional neutrality, which is one of a trader's most valuable psychological assets. When you're comfortable doing nothing, you stop tying your self-worth to constant action. You stop equating trading with clicking. You begin to understand that your job is not to trade every move, but to wait for the right ones. The market doesn't care how much excitement you crave. It rewards those who act with intention, and intention can only come from patience. Have you ever entered a trade and immediately realized you didn't truly want it? You just wanted to be doing something. Stillness is where your edge matures. Anyone can take a trade when the chart looks dramatic. But only a disciplined trader can sit through 6 hours of sideways action, sticking to their plan, refusing to force anything. That trader is building mental resilience, sharpening their observation skills, and preserving their capital, all without placing a single order. It's ironic, but some of the best trading work happens when you're not trading at all. And here's something most traders don't realize. The market's biggest moves punish the impatient before rewarding the patient. The false breakouts, the whipsaws, the fake strength. They shake out the crowd. They test your resolve. They ask whether you can withstand the temptation to act without reason. When you stay patient, you let the market finish its games before you step in. You avoid the noise that blinds others. You wait for the structure that supports true trends. And when that structure finally shows, you're ready, calm, clear-minded, and positioned to act with purpose rather than emotion. Sideways ranges following strong moves often indicate healthy digestion, not exhaustion. and this is one of the most overlooked truths in trading. Most traders see a stock run up sharply, then drift sideways, and they immediately think the move is finished. They assume the stock has lost momentum or that the buyers are out of fuel. But in many cases, that sideways drift is not a sign of fatigue. It's a sign of strength. It's the market catching its breath, tightening its structure, and preparing for the next leg. Have you ever exited a winning trade too early just because the stock started moving sideways? A strong trend doesn't usually travel in a straight line. It moves, pauses, moves, pauses. Those pauses, especially the tight, controlled ones, are what keep a trend healthy. They shake out weak hands, give late buyers a chance to join, and keep greed from pushing the move too far, too fast. When you see a stock rip upward and then hold its ground without giving back much of the gain, what you're looking at is digestion. The market is absorbing the recent action. It's processing new levels of supply and demand. And if the stock refuses to fall during that digestion period, that's a powerful tell. Haven't you noticed how some of the best breakouts happen not right after a decline, but after a smooth, steady sideways drift? A stock that's truly exhausted behaves differently. It gets sloppy. It forms wide, erratic candles. It snaps back violently on minor selling pressure. It doesn't rest. It stumbles. A healthy trend, on the other hand, shows balance during its rest. It tightens. It compresses. It holds above key levels with calm, almost disciplined price action. That calm is not random. It's a sign that strong buyers are still in control. They're not panicking out. They're not rushing in either. They're simply holding, letting the market adjust. This is why understanding sideways ranges is so valuable. They reveal the intention behind the move rather than just the movement itself. Sideways digestion is where the market tests the commitment of traders. It asks, are you patient enough to sit through this? Many traders aren't. They want immediate continuation. They want the trend to reward them instantly. But trends don't exist for our comfort. They exist because of underlying demand. And demand needs time to reinforce itself. That sideways range is the reinforcement. It's the market telling you, the move is not over unless price shows real weakness. So ask yourself, do you see sideways action as a threat or as an opportunity? One of the most useful things about sideways digestion is how it clarifies levels. When price drifts sideways, it forms a range with a clear top and bottom. This gives you a structure you can trade around. You know where the buyers are defending. You know where the sellers are sitting. You can see the pressure points. And once you see those pressure points, you have a roadmap. Breakouts from tight ranges often travel smoothly because the stock has already fought the battle of supply and demand inside that range. By the time it breaks out, resistance has weakened, sellers have thinned, and the path upward becomes cleaner. Have you ever seen a breakout feel almost effortless because the stock spent time tightening beforehand? Sideways digestion also improves your risk control. When the range is narrow and stable, your stop loss can be placed with greater precision. You're no longer dealing with wild swings that shake you out before the real move begins. Instead, you're dealing with orderly, predictable action. Predictable not in direction, but in structure. Structure is what allows you to plan, not guess. Most traders underestimate the power of structure because they're too focused on speed. But speed without structure is just chaos. Structure without speed, however, is preparation. And preparation is the real advantage of these ranges. They give you time to analyze without being rushed. You can study the candlestick behavior. You can examine whether volume is decreasing, which often indicates selling pressure is drying up. You can see whether each dip is getting bought faster than the last. These small clues add up to a bigger picture. They tell you whether the trend still has life. And more often than not, a strong trend doesn't end in a tight range. It ends in volatility, panic, or sharp reversals. A calm range is not the sound of ending. It's the sound of gathering energy. You also develop mental resilience when you learn to appreciate digestion periods. Instead of interpreting stillness as a problem, you start seeing it as natural, even necessary. You stop getting nervous when the stock isn't moving in your favor every minute. You stop demanding perfection from every chart. Your mindset shifts from, "Why isn't it moving?" to, "Good, it's holding where it should." That kind of mindset reduces emotional stress and helps you stay aligned with the larger trend instead of getting lost in the small fluctuations. Have you ever felt yourself sabotaging a perfectly good trade just because it wasn't moving fast enough? Sideways digestion teaches you to trust the market's rhythm instead of trying to force your own. Every strong trend needs air, and the sideways phase is that breath. It's the market conserving energy, attracting new buyers, discouraging impatient ones, and creating the foundation for the next leg. If you only chase charts that move vertically without any rest, you're chasing instability. But if you learn to respect the sideways flaws that appear after a strong move, you start spotting the setups that have the durability to continue. You start seeing the depth behind the move rather than the surface. You start understanding that strength doesn't always shout. Sometimes it stands still, quietly, confidently, before continuing on its path.